Inflation in the U.S. proving to be tough to tame. The consumer price index coming in hotter than expected, up 0.1% in August and up 8.3% year over year. That's even with a drop in gas prices. And this now raises expectations that we will see a more hawkish Fed. Meanwhile, the effects of the Fed's moves on the US dollar are being closely monitored by the BRICS: Brazil, Russia, India, China, and South Africa, who are reportedly developing their own global reserve currency. Recently, India and Russia have said that they no longer need the US dollar to conduct trade, and there's growing speculation that this new currency could be backed by a basket of commodities, including gold. And this all comes as Russia has been proposing a new gold trading body, the Moscow Gold Standard, to rival the LBMA. And in fact, Russia's biggest gold producer has now started to issue bonds in Chinese yuan. Well, our next guest argues that this is all part of a move towards the bifurcation of the global monetary system, and gold will play a big role in this. Matthew Piepenburg is the commercial director at Matterhorn Asset Management and the author of several books, including Gold Matters: Real Solutions to Surreal Risks. Matthew, welcome to Kitco.
Great to be here, Michelle. Looking forward to swapping thoughts.
All right, lots of thoughts, but let's start off by getting your thoughts and reaction to the latest CPI data coming in hotter than expected, up 0.1% for the month of August, up 8.3% year over year. Now, core CPI, which excludes food and energy, that rose 0.6% from July to August and 6.3% from the same time last year. Markets tanking on this news. Matthew, what does this mean for the Fed?
There's so many ways to answer that question. I think the first part, obviously, the markets have already priced in probably a 75 basis point rate hike in September on the 20th or the 21st from the Fed. And they won't meet again until November. I think this new data, headline inflation and core inflation, will give Powell the extra energy he needs to possibly go from 75 bips to even 100 bips in September. I think the larger question about the Fed, and certainly the markets are reacting as well negatively today on this, raising rates into what is clearly a recession, and a debt-driven risk asset market doesn't like to see the price of debt or rates go up. So there's a reaction. At 30,000 feet, stepping back from that, you have to look at the Fed, though. It's basis points from the BLS on talking about core CPI inflation or headline inflation. It's interesting, but it denies the larger issue of the staggering amount of delusion or disingenuous data points that come out of DC. And that's not flat earth, tinfoil hatted, sensational conspiracy theory. It's an open secret on Wall Street that the CPI inflation scale is as bogus as a 42nd Street Rolex. And again, when we talk about the Volcker era, or even Powell wanting to be the next Volcker instead of the last Arthur Burns, it's absolutely astounding. If we want to use the scale used to measure CPI inflation during the Volcker era, real inflation today would be closer to 18 or 19%, not 8 to 9%. So you have to step back and just ask, what's even the very honesty of the BLS's data points on inflation? But clearly inflation is not transitory, it's sticky, and that was something that we knew years ago, and certainly last year at Jackson Hole, when it was still transitory at the time. What's interesting about Jackson Hole 2 this year, as opposed to last year, is just, again, the staggering level of what I would call mythology, or if you want to get darker, dishonesty coming out of Powell's lips or the FOMC in general. And one of the most obvious examples of that, even at Jackson Hole, when Powell talks about softening demand, getting ready for softening demand because of data points on inflation or persistent inflation, I think that's incredibly rich when you think about it, because the central banks in general, and Powell's Fed in particular, has been responsible for the greatest risk transfer, wealth transfer in U.S. history. We've never seen greater wealth inequality. And since 2009, when temporary QE1 became QE2, QE3, QE4, Operation Twist, and then unlimited QE after the convenient COVID crisis, this massive amount, hundreds and hundreds of percentage points in the S&P markets, it's important to recognize that 85% of the S&P wealth is held by only 10% of the U.S. population, the higher 10%. So when you talk about softening demand from Powell, just like when you talk about transitory inflation, it's very disingenuous, because softening demand is just a euphemism for crushing the U.S. working class and the ever-dwindling middle class. So that's kind of the first thing I think that kind of when I noticed how Powell can just act as if the Fed doesn't have an impact on wealth equality, or doesn't have an impact on social unrest, or certainly on a wealth transfer. And there was a famous quote by Andrew Jackson in 1830s, the president, who said that the central banks, the private central bank, is effectively the prostitution of the government at the expense of the many to the benefit of the few. And that really is what we're seeing with the working class, and how Fed kind of mouthpieces like Powell just walk right past that, calling something softening demand. But I think there are other examples besides just the CPI scale where the Fed has just been completely disingenuous. I mean, real rates, when you have a yield on the 10-year of around 3% and inflation at 8 to 9%, you have negative real rates of at least 5 to 6%. That's a negative real rate environment, but yet the Cleveland Fed will tell you we have positive +1 real rates using proprietary metrics and long-term expectations on the 10-year bond. Again, that's an open fiction that's been reverse engineered to create positive optics when the reality of the empirical reality, the numbers are not true. I also think unemployment, which is another reason they say we're not in a recession. Unemployment numbers at 3.5% are record lows for our country, but that's, it's in contradiction to the open household surveys done by Price Waterhouse or with our own two eyes, and even the way the BLS measures unemployment. So from whether it's the CPI scale or whether it's real rates or whether it's unemployment, you're seeing just a lot of small talk or soft talk and optics talk, but it's not real talk. I think the other classic example of this kind of dishonesty from the Fed is even the notion that the Fed is using rising rates to fight inflation. I think that's entirely disingenuous. Whether we get to a neutral rate or not, when you've got 8 to 9% CPI inflation, you're not going to fight that with a 4%, 3%, or even 5% Fed funds rate, which we can't even afford. So that isn't the truth. The real truth is that the Fed, like most central banks throughout history, wants inflation to be higher than interest rates. It wants negative real rates because every debt-soaked nation who has its back against a wall throughout history has tried to inflate away its debt by having inflation higher than reported interest rates. So when you can doctor the inflation rates and pretend you have positive real rates when you're actually seeking negative real rates. I think Powell is seeking inflation. He's not fighting inflation. I think he's seeking negative real rates because he's desperate. He has no choice. And the only reason they're raising rates today is not to fight inflation, so they'll have anything to cut when the real recession becomes an official recession at some point when the BLS decides to call it that, or the National Board of Economic Review. Okay. So I mean, there's a lot of disingenuous data coming out of the Fed, and I don't think that's sensational anymore. I think most of us know that.
All right, that was a lot of data that just came out of you, Matthew. many concepts to process over there. Mm-hmm. Let me start by trying to break it down. On the very near term, you're expecting 75 basis points, maybe a full percent coming in the next meeting. Grand scheme of things, irrelevant anyway, because you think that all of the inflation data, as many do agree, is not exactly an accurate reflection of what's going on. But even in the bigger picture, you're saying that you don't think Powell's intention is really to rein in inflation. He claims that it is. Granted, this is the same man that told us inflation was transitory, but he claims that it is. His last address at the Cato Institute, he said he was committed to bringing down inflation and keeping at it. He seems to be channeling his inner Volcker, but you're not buying any of that. You think he's going to raise a little bit, cave and pivot? Is that what you're saying?
And I don't want to create a psychological profile of a man I don't know, but central bankers are pretty consistent because they operate on very simple leverage points. And I think maybe at some egotistical level, Jerome Powell is afraid of going down as the next Arthur Burns. But look, this idea of a Volcker comparison or being tough on inflation in the way that Lyle Brainerd talks about or Neil Kashkari or Jerome Powell, again, looking at basic empirical math, not just cynicism that I have about the central bank that was created on Jekyll Island in 1913, unimmaculately. Even if you just look at simple math, to compare our current era to the Volcker era on basic math is incredibly farcical, because we had in 1980 a 30% debt to GDP and a public debt of about 900 billion. Today we have 125% debt to GDP and over 30 trillion in government or public debt. Powell can't afford to be Powell. He can't afford to be Paul Volcker. It's mathematical. So this notion that we can pretend optically to puff our chest for the headlines to fight inflation, it defies all basic mathematical principles. And so the U.S. government's bar tab can't afford rising rates to the point where something has to break. And the Fed is between a rock and a hard place of its own making. If it prints more money and pivots, it creates more inflation through money supply. If it raises rates to fight inflation, it cripples the economy and destroys the market. So it's either an inflationary nightmare or a depressionary economy. And in the meantime, they're buying time. They're looking for folks to blame, whether it's Putin, COVID, or climate change. You'll never see a central banker take responsibility for their policies, ever. They'll never make that mistake. So they'll always find scapegoats or excuses or words. When the math is too bad, the words get more fluffy.
Well, we have seen that. Now, look, granted, monetary policy played a role in this, but certainly so did fiscal policy. And the Fed can do all it can, but when the government continues to create more stimulus through legislation and more bills, it doesn't really matter how much the Fed will be raising rates. I want to get your bigger outlook then on the U.S. economy. We've got the likes of Elon Musk and Cathie Wood sounding the deflation alarm, though. What is your outlook there? How does this play out then in terms of recession, stagflation, possible deflation? Mm-hmm. How do you see this playing out over the next year?
That's interesting. I mean, inflation and deflation are always in cycles together. Inflation is followed often by deflation. I think the forces, it also depends on how you define inflation, whether that's based on the money supply or whether that's based on asset prices, whether it's stocks and bonds. If you're looking at stock indexes, we're going to see deflation if stocks fall because stocks survive on a low interest rate environment. Everything hinges on the credit markets. When rates are cheap, markets are high, prices are high. That's inflationary. And we see inflation in the risk assets. So when you're talking about deflation, yes, you'll see deflation in prices because you'll see a slowing in demand in a recession. But the inflation that I define is based on the money supply and it's the inherent purchasing power of the currency. I think we'll see a very disinflationary wave in a recession. I think it's also clear to Powell that he's not going to fight inflation with high rates. He's going to fight inflation with the recession, that he's masterminded indirectly or because he has no choice. And no country, no nation, no empire in the history of modern capitalism has ever survived or gotten through or defeated a recession with a strong currency and rising rates. So the recession, when it becomes official, will create the context for the pivot to more money printing, which will be inherently inflationary. So I think we'll see disinflationary forces and deflation in asset classes, but we'll probably see a situation of stagflation because supply-driven inflation or supply-constraint-driven inflation and money supply expansion inflation is not going to be defeated by interest rates. Inflation will be defeated by a recession, which again will cripple the vast majority of middle-class Americans and even upper-class Americans because inflation hurts all Americans, but it cripples the working class. And Powell will then be able to defeat inflation through a recession, but I think we'll still see the decline of the dollar's purchasing power, rising prices nevertheless for goods and services and healthcare, and yet a stagnant economy. So there's a very high risk of stagflation. Again, Powell, whoever is in the central bank at that time, will look for someone to blame or something to blame other than mouse click money for years that is completely and in itself inherently inflationary. When you create money that's not corroborated or connected to an asset or a good or a service, that is an inherently inflationary mouse click money. And we can't blame that on COVID and we can't blame that on Putin, whatever you think of either.
Matthew, assuming that we have a honest chair of the central bank and assuming Powell actually means what he says and he does hold the line and he does fight inflation and we have austere times, but somehow we come out of it okay. Is there a scenario here, given the current circumstances, where this doesn't result in the doom and gloom that you're predicting?
Look, is sensational as it may sound, or is doom and gloom? We're already seeing the doom and gloom. It's being felt in the U.S. where I am now, but in Europe where I live, it percolates and ripple effects everywhere. I don't see a scenario where we can pay for our own public debt. If our tax receipts are declining, if our GDP is declining, how do you pay for the IOUs we've been sending out that come to maturity every so often? If there's no tax receipts in a recession or declining tax receipts, obviously tax receipts, you're having declining tax receipts and declining GDP and declining productivity, how do you pay for those IOUs? You either default, which we can't do, and technically you can never default if you can create mouse click money. So you add a couple zeros when needed to the balance sheet at the Treasury, and then you pay for that. That will be inflationary despite the demand declines. So that's why I think stagflation is very possible. I don't think it's the end of America. I don't think it's the end of the world. I don't think it's even the end of the US dollar, but it's a pivotal shift coming our way, and it's going to be, the next 10 years will not be as pleasant as the last 10 years. Again, we've been living beyond our means on low interest rates and a repressed, coiled interest rate policy and printed money. When you inverse that, if the everything bubble and the joy and the euphoria we've been experiencing since 2009 was based on basically a low rate policy, a rising rate policy and a rising yield policy will be the inverse of that. So those good times will become very negative times. It's not sensationalism. It's frankly blunt math, in my opinion.
I'm just seeing if there's any way out of this scenario that you're forecasting, which many of our guests on Kitco are also forecasting, for the record. Yeah. Apparently, it's beyond the realms of possibility that some sound policy and some good Fed chair, and even a stable government can get us out of this. But you're saying it's not necessarily the end of the dollar. So what does this scenario mean for the dollar?
Well, look, the dollar right now, unlike other central banks, the Fed, as the holder of the world reserve currency, has immense powers. You never can underestimate the Fed. Whatever I think of the Fed, I respect the powers that it has. And unlike the European Central Bank or the Bank of Japan or the Bank of England, the Fed can raise rates 300 basis points in a 6-month period that other central banks simply can't do. They can't afford that type of rate hikes and that type of debt cost. So the Fed can do this, but at some point it will have to pivot, not even just because of a recession or because markets are tanking or they need to reduce rates to fight the recession. The US dollar has gotten too strong. When you raise rates and you even do quantitative tightening and add more treasury bonds into the supply, that brings the bond yields up. That also strengthens the yield and it strengthens the FFR, the Fed funds rate. That combination makes the dollar stronger. It's a disastrous policy, because it forces the dollar to go into a situation where emerging markets with own trillions in emerging market debt that's U.S. dollar denominated are stretched too thin. And it's in the derivative markets contracts. There's all kinds of forces at play. They're going to make the dollar weaker. Right now, the Fed, Larry Summers, giving advice with Powell and Yellen and Biden, to the extent he's cognitively aware, thought that a rising dollar would attract foreign money and that it would be, it's certainly a temporary rising dollar. It's not a sustainable thing to have this dollar this strong, this long. But for now, unlike any other central bank, it can play this game of a strong dollar. Of course, that's incredibly crippling to the gold and silver prices. Of course it is. Right. But for now, it's a very, and I hate to say the word temporary, but this rising dollar policy is very, very temporary. It's not sustainable for so many reasons. But the main thing is it's important to know that when the dollar at a technical level is trading, when the DXY at 108 has been trading, the dollar index has been trading for 14 months above its quarterly moving average. And as Michael Oliver said, that's like a runner that never exhales. For me, it's like a drinker who never takes a glass of water, but just keeps ripping martinis. That many months of a strong index creates a scenario where the runner has either a heart attack or an epic hangover. So the dollar will rise as it is now. It will cripple a lot of asset classes, everything in its path. But at some point, it will, like Hemingway's description of poverty, it will unfold slowly and then all at once. And when the DXY slips between 108 to 107 to 106, when the markets hit their June lows, it's going to be very fast and very painful. And again, it's not meant to be doom and gloom. It's just the law of debt and the law of pricing. And I don't see any way out of it. I really don't. It would be nice to see a central banker be honest about it. Tell the American people or the European people, look, we've been over our skis. We're over our skis in debt. We overestimated this. There's going to be austerity. It's somewhat our fault. We're sorry. Let's come together and do this. But to take no responsibility and then blame it on COVID, climate change, or Putin is incredibly, in my opinion, it lacks a lot of courage and honesty. There's certainly no profiles in courage over at the FOMC.
Right. So what should an investor do then in this scenario? We've got the dollar gaining strength, but you're saying that is temporary. In the meantime, we've got gold down around 1723, 1720 levels, even on that strong dollar. What is the best way for an investor to be positioned given this scenario?
Well, first, everyone's going to roll their eyes. As a gold executive, I'm going to say gold is an investment. I'll explain why I think it is a good investment. But as someone who spent 20 years in risk assets only, stocks, equities, credits, arbitrage strategies, I understand the danger of risk security portfolios. Even Michael Hartnett over at DFA, who's a brilliant analyst, in my opinion, I mean, he has said publicly the biggest trade of the year is probably shorting the U.S. dollar and going long emerging markets because there are such massive shifts right now. So I think investors should be very wary of, before I even talk about precious metals, investors should be very wary of your standard 60-40, 70-30 stock bond portfolio, because equities and credits are so highly correlated and so highly exaggerated and overvalued simultaneously. So you're not going to have one zig while the other zags. There's going to be no hedging in a traditional portfolio. So I think you have to stay clear of the assumption that, again, no one can time markets, but these are two overvalued asset class. When the U.S. dollar makes what Hartnett calls the great short, when the U.S. dollar starts to sink, well, then that's finally, when the dollar snaps, what sends real assets in general and gold in particular to new highs. And right now, gold is being repressed by a number of forces, but the 10-second answer is open and obvious. When you've got a dollar this strong, when it is literally, and I hate to use the cliche, the best horse in the glue factory or the best shirt in a dirty laundry, there's no denying that it is. It's not sustainable, but right now it's certainly got its boot to the neck of the gold price. So that U.S. dollar, though, will reverse down, and that will send gold out of this repressed zone. And again, other forces affect the gold price. It's an open and obvious secret what the OTC and the COMEX markets do with hundreds of, unbelievable amounts of forward contracts that have nothing to do with the physical supply. And you see the BIS has just unwound its credits, its swaps in the gold market by 90%, from 500 tons to 50 tons. But meanwhile, JP Morgan and Citibank just lifted the notional value of their gold derivatives by over 520%. And JP Morgan and Citi are doing what they're doing. They're artificially repressing the gold price, legally allowed by these OTC market rules and the LBMA rules, so that they can collect more physical gold. So when it's time to use gold again, they've already bought it at the cheap. So they're fixing the price of gold legally. They're repressing it to buy more of it. You're trying to see more physical delivery in the OTC market or the COMEX market. But believe me, Citibank and Morgan will get their physical gold first before they let the gold price rise. And that gold price will rise when the dollar tanks. It's very simple, sadly. Those are the two forces in my mind that are having the biggest impact on the gold price.